Thank you for coming into this quick training on the federal tax formula. What we're going to try to accomplish today is we just go over a quick review of how your taxes are calculated in the United States. Um, this is by no means any tax advice or any complete explanation of what happens on your tax return, but rather a quick way of you figuring out uh, pretty much what 80% of your tax return looks like. The intention is that in other sections, I will be adding more items to this and explaining each one of the accounts so you could do it. But in the next 5 or so minutes, I would like to just go ahead and give you a explanation on how the tax formula works and what it entails. So right here, you can see that the tax formula has the following items. The first thing is gross income. Gross income is pretty much what you have earned during the year. So if you work at a restaurant or if you work at an office and you receive a W-2 for, let's say, $40,000, that's what your gross income is. The gross income may include other stuff, but for our purposes, we are only going to talk about your W-2 income or your regular wages income. Then you have some adjustments that could happen. Generally, these adjustments could be IRA contributions or could be moving expenses with some rules, or if you paid alimony to somebody, you could reduce the amount that you paid, or if you contributed to a health savings account. Again, we're not going to have any adjustments. This is just a basic tax formula, but if you did have some adjustments or some over the line deductions, this would be. So gross income minus adjustments will equal to adjusted gross income. After adjusting the adjusted gross income, you will have to figure out what your standard deduction is, what your personal exemptions are. So your standard deduction for 2014, you have a table out here. It depends on what your filing status is, whether you're married, you're married filing jointly, you are head of household, or if you are single. Your standard deduction, if you are single, for example, for 2014 is 6,200. Head of house is 9,100, and married filing jointly is 12,400. Every year, this amount changes, and every year, this amount is provided to you by the IRS. So none of these numbers were, made up. Uh, this would be. You also have something called exemptions, and an exemption is an amount of money that you can reduce your taxes from, depending on how many people are in your taxes. That's pretty much the most basic thing that I could do. That you could do it, or the least complicated way. If you are filing for yourself and you have one dependent, that's two people in your taxes. If it's you and your spouse and your two children, that's four people in your taxes. And for every person that you have on your taxes, for every person that you have in that tax return, you're going to reduce the amount by $3,950. After that, after you reduce all this money, you're going to arrive to something that is called taxable income. Taxable income is the amount of money that you are responsible to pay taxes for. So you're not responsible to pay taxes for the gross income amount that you file on your W-2. You're actually responsible to pay taxes on the taxable income that you have when you reduce it by the adjustments, the standard deduction, or the deductions and exemption. After you arrive to this number, you actually have to see a table to figure out what your tax rate is, or what your tax calculation is. Pretty much we live in a marginal tax system. So for every extra dollar that you make that is over a certain amount of income, you're going to pay more taxes. So let me give you an example. If your filing status is single and you made $30,000, for the first $9,075, you're going to pay 10% of your income. For the next, for the money that is above the $9,000, but is all the way up to 30, you're going to pay 15% of your income. That's why that's 15% is here. But the tool that we have here allows you to create a lab. You know, it has you have the ability to kind of like have a better system on how to do it, because it just tells you, you figure out where your taxes are, and whatever line the amount of money lines on, all you have to do is reduce your taxable income minus whatever number you see here, and then multiply by 15%, and then add the rest. I will give you a few examples so you can figure out what the taxes are later on. After you receive the total tax, you reduce for any tax credits you may have, any tax payments that were withheld from your paycheck. I believe this word is misspelled, but we're going to keep it there. And then we have then any penalty, we add back any penalties you have. If your number is a negative number, you have a refund. If your number is a positive number, you owe more taxes than what you suggested. I think that it's easier for us to go ahead and just go over an example on this. Hopefully, you get to do one example with me, and then after that, you get encouraged to actually go ahead and do an example on your own. And so I will give you time to figure out what one of the examples, and then after that you'll be able to do it on your own as well. So the first thing that we're going to do is we have a person that is single. The person earned $40,000 in a year, and the person withhold from their checks. So this is single, that's the filing status. This is the W-2 income, and then they withheld $4,500 in federal taxes. Keep in mind that the withholding has nothing to do with how much money you are going to pay on your taxes. And your withholding for federal is what gets counted here. On your check, they actually take away more than that. They take away Social Security, Medicare, and state taxes if you live in a state that charges income tax, and that you have to pay income tax for, or if you live in a city that you pay income tax for, you have to charge it too. We're just only talking about the federal tax withheld, and this information will be provided by the W-2. So let's go ahead and go over with this example. So here we have gross income, and the gross income is $40,000. After that, it's telling us to pretty much just go ahead and reduce the taxable income by the adjustments. Right now, we don't have any adjustments, so the adjustments will be zero. And the adjusted gross income is going to be $40,000 minus adjustments. So that becomes $40,000. So your adjusted gross income in this case will still be $40,000 because there's no adjustments. After that, we have to remove an exemption. The standard deduction. So in this case, again, this is a given. So we know that we have to reduce it by the standard deduction. So we go to the income tax rates, and we see that the standard deduction for a single person is $6,200. So we're going to go here and say minus $6,200. That's your standard deduction. And then it's telling us to reduce it by your personal exemption. Your personal exemption is $3,950. Again, this is a number that is given to us. So we're going to do minus $3,950 times the amount of people in this taxes, which in this case is just one. So that's your exemption. When you equal this, it's going to do just a sum of all these numbers. So it's going to be this minus this minus this. It's going to be equal to $2,950. So right now we are right here on this $2,950. Let me just go ahead and make it clear here that we have this $2,950 number here. And let me just make it clear that this is your AGR here as well, just so we follow the pattern. So the next thing that we have to do is we have to go ahead and multiply 2950 by our tax rate. This is where a little bit of math comes about. So we know already that our number is 2950. So we have to find 2950 in this single filing status table. So again, we have all this information given to us. We have to find the single status table and find where 2950 lies. So if we take a look real quick, we see that 2950 is between these two numbers here. So if this is what we have, we just could go ahead and take this as information, and we know that we have that the rule that we have to follow is that we have to take $907.50 plus 15% of the difference between 29,850 and 9,075. So let's go ahead and figure this out. Again, we're going to do 907.5, and then we're going to do the difference between 29,850 minus 9,075. So we're going to do equals 29,850 minus 9,075. That's going to be equal to 20,775. We can then go ahead and multiply that by 15%, which is $3,116.25. So our total tax, it's going to be 907.5 plus the difference. The excess over 9,075 is the difference between 29 and 975, which is this, multiplied by 15%, which is this, which is going to give us $3,023.75. The IRS doesn't like those numbers, so you actually have to keep it, you have to round up. So in this case, this is your total tax. Your total tax at this moment is of $40,000 as a single individual is $4,023.75. Again, we have to reduce this, $20,024. After you have the total tax, what you have to do is you have to go ahead and reduce any tax credits you have. In this case, we don't have any tax credits, so we're just going to minus 0. Then we have any payments we have. We have payments here, minus 4,500. And we don't have any penalties, so we don't have to worry about that. So when we actually go ahead and take care of the final numbers, we have 4,024 minus 4,500 equals minus $476. And the rule says if this is negative, you get a refund. If this is positive, you have tax due. So in this case, the person gets a refund of $476 for the federal taxation. All right. So I hope this helps you figure out how to do it. Feel free to go back and take a look at the example again. What I'm going to do again, because I know that you could go ahead and go back and click back as much times as you want to have the conversation, we're just going to go ahead and dive into another example so we could go ahead and get used to using this tool. So again, in this case, we're going to have a married filing jointly couple, no kids. They made $40,000, same idea, but they had $4,500 taxes with her. Let's see how just being married would change your tax status. So in this case, $40,000 is still the same situation. So actually, this is what I would like you to do. I'm going to go ahead and erase these numbers. I would like you to go ahead and press pause and take some time to just go ahead and see if you can, with this information, and just by following with what I did last time, you can go ahead and get the answer. So I trust you're going to go ahead and press pause, and then I'm going to go ahead and do it with you. All right, let's see if you got the same answer as I did. So we have $40,000 as gross income. 4 is 1, 2, 3. We have 0 adjustments, so we're going to just do minus 0. That's going to be equal to adjusted gross income, which is $40,000, less the standard deduction. Again, we're going to go back to this table, and I'm going to put the Excel file on the bottom so you can go ahead and practice. And on this table, we see that standard deduction for 2014 for a married filing joint individual is $12,400. So we're going to put in here minus $12,400. And then we're going to put here personal assumptions. Now, this is a tricky one because if you're married, there's 2 people in your taxes. So if there's 2 people in your taxes, you're actually going to have to put 2 assumptions. So we're going to do minus 2, the number of assumptions, multiplied by 3950, which is the amount of the assumption that you're getting. Where did I get 3950? Easy. It's a given by the IRS. Personal assumption, 3950 for the year 2014. So we have here 12,400 as a standard deduction, 7,900 as a personal assumption because it's 2 people in the taxes. So in this case, we're going to go ahead and again, we're going to add these things together. The reason why I'm adding is because it's our negative number, and plus and minus is minus. So we're actually just subtracting it. Just in case you were wondering why we're just adding these numbers, is because the numbers are negative, so we actually are subtracting those numbers. So after you do that, you figure out that the number, the taxable income for a married filing joint individual is now $19,700. Then we're gonna go to the not so easy part. We have to go ahead and go back to the tax rates. We said that this is a single filing status. This is not what we're going to use. We're going to use the married filing jointly filing status, and that status says that if your income is $19,700, you do not use this table because the income is not this, but then we use the second part because we're doing 18,000 numbers between 18,150, but not over 73,000. We're going to copy and paste this again, so we have the ability to just take a look at it here without any issues, and hopefully that helps us go ahead and get the information fairly quickly. Let me just go ahead and make sure that this test is not wrapped so it doesn't go down like that. So we have here again that our taxes are going to be $18,015 plus the difference plus 15% of the difference between 19,700 and 18,150. So we're going to do 19,700 minus 18,150. That equals to $1,150. And then we're going to multiply that by 15%. That's going to be $232. So the total tax will be equal to $18,050 plus 15% of the difference between 19,700 and 18,150, which is $232.50, and our total tax is $2,048. To that, we're going to subtract any credits that we have. We're going to subtract any payments that we made, and we're going to add any penalties that we made. We have no penalties, so it's 0. And then we're going to just go ahead and sum them up together. Again, the reason why we're adding them up together is because whatever number is negative has a negative connotation already on the on the tool, and it's telling us that just because you're married, if you have the same income as total income as family, of course, there's two people working, you will now get a refund of $2,452. Now let's go ahead and do another one. Again, the reason why I'm going fast is because I'm assuming that you have the ability to go ahead and stop it, go back as much times as you want. Um, let's go ahead and change things a little bit so we can see how taxes work for different individuals. So let's go ahead and erase this again. And let's go ahead and put, instead of married filing jointly, let's put in a single mother. So it's a head of household. And this single mother has 2 children. I'm going to add another thing that I haven't added before. For every children that you have, and this has all the rules. This is just a simple, a very simplistic way of putting it. For every children that you have, you will receive a $1,000 credit. So one child equals $1,000 credit. This is not true in many cases, but it's safe to say that for a lot of people, this is the situation. And this is because of a credit called the child tax credit. So let's see how we can go ahead and work this out. So we have a head of household person, a single mother with 2 children, with an income of $45,000 on a W-2, and she withheld $4,000 in taxes. I'm going to give you a little bit of time for you to be able to figure out, and I'm going to go ahead and start. Press stop, work on it, and restart again. All right, I'm going to go ahead and start for you now. So again, gross income is $45,000. We received that from the W-2. There's no adjustment, so your adjusted gross income is going to be $45,000. A standard deduction for a head of household. We're going to go to the tax table and we're going to figure out what the standard deduction for a head of household is. In this case, the standard deduction for a head of household is $9,100. So we're going to go ahead and put in here where it says a standard deduction less minus $9,100. Again, where did I get that number? I got it from here, $9,100. Then we have personal exemption. In this case, we don't have, how many people we have in the taxes? We have the mother, the head of household taxpayer, and 2 children. So that's 3 people in taxes. So in order for you to figure out how much money you would charge as a personal exemption, it will be, again, we're just doing negative because we have to subtract it, but it's going to be $3,950 multiplied by 3, which is going to be $11,850 because we have 3 exemptions. So if we calculate that, again, I'm just gonna add it together because the numbers on the standard deduction and the personal exceptions are already being subtracted because they're negative. So her taxable income in this case is going to be $24,050 out of the $45,000. Now we need to figure out the tax rate. Again, this is a number that is given to us, so we know that it's $24,050. We have to go to the head of household filing status box, and in this head of household filing status box we see that if your income is between 13,000 and 50,000, you will use this box here. So again, we're going to take this box, we're going to put it here just so it helps us with our math. Well, we'll be using it here, so I don't know why you need it there. So I'm just going to go ahead and take off the wrap text, and we're going to do the same thing. So we have $1,295 plus the excess or the difference between 24,000 and 12,995, 12,950. So it's going to be equal to 24,000 minus 12,950. That's 11,100. And then with that, we're going to multiply it by 15%. How we get 15%? Because of the rule. It says 1295 plus the excess, the 15% of the excess of 2450 minus 12950, which is 11100, multiplied by 15%, which is 1650. So we can go ahead and do the math. So it's equals to this plus the excess plus the 15% of the difference between those two numbers, which is equal to 2,960. And 2,960 is our total tax. So out of $24,000 in income, this taxpayer needs to pay 2,960 in taxes. Now we're going to subtract any tax credits, and remember, for every child, we're going to give them $1,000. So we're going to be minus 2,000. This is real. This is a credit called the child tax credit, and for a lot of people do qualify for this. Minus any tax payments withheld, she withheld $4,000 from her paycheck. Minus any tax credits, minus $4,000 of tax payments. That's a difference of $3,040 in the negative side. So this is a refund of $3,040. I hope you are able to use this tax formula to help you with your tax information, or to help you to decipher some numbers. If you have any questions, you can go ahead and put it on the section below. I'm also going to create a link so you can go ahead and access this Excel sheet, and you could download it, and you could work with some examples as well. In the following weeks, I'll probably post some information on filing statuses and different other information on taxes. But I hope this basic tax formula allows you to get a better idea how taxes work in the U.S. Again, we put our gross income, we reduce any adjustments we may have. We're going to adjust the gross income. Then we reduce the standard deduction, which is a number given to us by the IRS every year. And it usually goes up every year as well, depending on what your filing status is. Reduce it by your personal exemption. For every person that you have in the taxes, there's $3,950 that you can reduce it for. The number is right here. And then after that, you could go ahead and get a taxable income. Taxable income, you have to do your tax rate. After the tax rate, you get your total tax, and this total tax is reduced by any tax credits and tax payments, and add any penalties you may have to if you have and then you add them all together. If it's a negative number, it's a refund. If it's a positive number, it's taxed. Thank you.